Hey, how you doing, everybody? It's good to see you. How's life? Good? Yeah? We're about halfway done through these lectures, aren't we? Semester's flying by, right? Time goes by quick when you're having fun, right? Are you having fun? Okay, good. Here's what we're going to do today. There was quite a bit of Chapter 5 homework, wasn't there? So thank you for doing that. Make sure you're doing that. You're not learning this material if you're not doing the homework. So make sure you're doing it. Folks at home, only you and God know if you're doing the homework, okay? I can't come check. So you have to do this homework to learn the material, okay? So let's go through it. What we're going to do is we're going to kind of finish up Chapter 5 today, and then we're going to dip our toe into Chapter 6, okay? So let's go ahead and start going through the homework. And I may go through these in a different order than what you did them in. That's okay. And I'm probably going to be jumping back and forth a little bit with some slides, because I think there was some material that I wanted you to read as well. Is that correct? Yes. Okay. So there's kind of a lot of little concepts here that we're kind of tying up Chapter 5 with. I don't think any of them are really that difficult, but it does hop around a little bit. So let's do exercise 5.4 first. Exercise 5.4. All right? So, exercise 5.4. Now, we talked about the sales cycle last time, didn't we? Okay? So, exercise 5.4, let me put that on the document camera for you folks at home if you need to look at that real quick. Okay? Exercise 5.4 is the one that we're going to be going through now. So let's take a look at it. Okay? All right, Allied Merchandisers was organized on May the 1st. Macy Company is a major customer, a buyer of Allied products, and they're the seller. Prepare journal entries to record the following transactions for Allied, assuming it uses a perpetual inventory system. We talked about that, right? And the gross method. Okay. All right. Let's look at May the 3rd. May the 3rd. Okay. Well, what happens on May the 3rd? Allied. Now, we are Allied, right? It says we make its first and only purchase of inventory for the period on May 3rd for 2,000 units at a price of $10 cash per unit for a total cost of $20,000. Okay? Now, there is the answer to that. Now, even though this exercise is primarily about the sales cycle, this is a purchase cycle, JE, is it not? Okay? I have graded literally thousands of these tests from chapters 5 and 6, okay? You have to make sure you're shifted into the right gear. Who am I? Am I purchasing? Am I selling? Okay? So here we're purchasing. Debit merchandise inventory, credit cash for $20,000. Cool? Let's go to the next one. On May the 5th, Allied sold 1,500 units in inventory for $14 per unit. Invoice total $21,000 to Macy Company under credit terms 210 net 60. The goods cost Allied $15,000. Now, do you see how if you're not real deliberate as far as shifting into the right gear, you might think that we're Macy and that we're purchasing here, but we're not, are we? We're selling. So, we have 2 journal entries to make there. Okay? Draw a line there to make it. Whoops. Okay, so, and let me draw one here too, just a second. Okay, so those are our 2 journal entries on May the 5th, correct? And again, don't combine those into one entry. Prefer that you keep those separate. But we debit AR and we credit sales for $21,000 to record the sale. And then since we're using perpetual inventory, we debit cost of goods sold, which is like an expense account, and we reduce merchandise inventory by crediting it for $15,000. This all looks so easy, okay? But when presented on a quiz or a test with blank pieces of paper and you have to produce all these entries, it gets more difficult than you might think, okay? All right, any questions on May 5th? Let's go to May 7th. Macy returns 125 units. Are we Macy? Who is Macy? That's our customer, right? Okay, we're still in the sales cycle. Macy, our customer, returns 125 units because they did not fit their needs. The invoice amount was $1,750. Allied, that's us, we restore the units which cost $1,250 to its inventory. Okay, so we have these two entries right here on May the 7th. Gotta bump that up a little bit, right? Okay, so take a look at those. All right. We don't debit sales. We debit sales, returns, and allowances. We don't debit sales discounts either. This is sales, returns, and allowances. For $1,750, we reduce or credit our AR by $1,750. We reduce by crediting cost of goods sold because these goods were, in the end, not sold. And we debit merchandise inventory because we put them back on the shelf. They must have been fine, and somebody else can purchase them. You with me? Any questions on May 7? Okay, let's go to May 8th. Macy discovers that 200 units are scuffed but still of use, and therefore they keep the units. Allied, we're Allied. We send Macy, our customer, a credit memo for $300 towards the original invoice amount to compensate for the damage. This is what a credit memo is, just this. When we're going to say, okay, we're going to knock off some of what you have to pay us. Okay? So we're going to give them credit for that. So we are going to debit sales, returns, and allowances, and we're going to credit accounts receivable. We're reducing our accounts receivable, aren't we? Okay. Now there's no second journal entry there. Okay. There's no second journal entry. That's it. Okay. Questions on May 8th? All right. How about the 15th? May the 15th. Allied receives payment from Macy for the amount owed on the May 5 purchase. Payment is net of returns, allowances, and any cash discount. Okay, I think it's a good question to ask. How much do they owe us? What is our receivable at this amount? Or at this point, I should say. Let's take a look. Well, it was $21,000, and then we reduced it by $1,750, and then we reduced it by $300. So what is our receivable going into this transaction? Do you know? Use your words. Hello? Is my mic on? Can you guys hear me? Okay. What is the accounts receivable balance?
20,700.
It is. It's. Does anybody have it?
18,950.
Very good, Mai. Very good, Mai. There is somebody out there. I was starting to worry. Okay, let me show you what I was doing here. Okay, this is our accounts receivable from, what's the name of the company? Macy? Is that right? Let's just do a little T account here. Well, we debited it for $21,000, right? Here we credited it for $1,750. And here we credited it for $300. Is that right? So what's the balance there? What's the balance?
18,950.
18,950. Okay? 18,950, right? Now, You see how we did that? Colton.
With the accounts receivable, would that be Allied instead of Macy? I thought Macy was the buyer.
First of all, thank you for asking a question. Just thank you. It's so nice to hear from you. Okay. It's a great question. No, it's not. We are Allied, right?
Yeah.
So this is accounts receivable from Macy.
Okay. So
Think if we sold Sprint something, then we would have a little AR account called AR from Sprint.
okay.
And then if we sold Garmin something, we'd have one called AR from Garmin. It's a great question, huh?
On the account, like where the receivables coming from.
Right. You know how sometimes they'll put that, I think they did that in the purchase cycle. Sometimes on the payable, they'll put in parentheses who it is. And we'll learn more about this in chapter 9, okay? But we really have a little accounts receivable from every customer. And we have that customer's name right there. Fantastic question. Thank you for clarifying. But yeah, this is all on Allied's books. Okay? All right. Other questions? Okay. Do they pay their $18,950 within the discount period? They do, don't they? Okay. So, do they have to pay us the full $18,950? No, they don't. They only have to pay us 98% of the $18,950, which is $18,571. $18,571 is 98% of $18,950, right? Now we credit or decrease the entire accounts receivable because it's gone. We're not going to receive any more from them. So what do we do with that little 2% amount, that $379? We debit sales discount, not sales returns and allowances, but sales discount. And sales discount, like sales returns and allowances, is what type of account?
Debit.
It's a debit balance account, but what type of account?
Contra revenue.
Contra revenue. So it's the opposite of a revenue, right? It's deducted from gross sales and arriving at net sales. Cool? All right. Any questions on that one? Now, when you guys get closer to the test, a great way to assess if you are ready for it is to hide your answer from that exercise, get out a blank piece of paper, look at your book, and see if you can do that. Okay? That's the way you assess if you know it. It looks really easy when I do it. And if you didn't do your homework and you're just kind of copying the answers down, okay, but be aware that that's not really learning, okay? The way you assess yourself is, can you produce it on a blank piece of paper? Cool? Okay, what's the next one? Exercise 5-6. Is that right? Exercise 5-6. Let's go through that one. All right. Santa Fe Retailing purchased merchandise as is with no returns from Mesa wholesalers with credit terms of $310 net 60 and an invoice price of $24,000. The merchandise had cost Mesa $16,000. Assume that both buyer and seller use a perpetual inventory system in the gross method. Prepare entries that the buyer records for all of this, and then prepare entries that the seller records for all of this, right? So let's go ahead and do that. And I believe this was the one I encouraged you to utilize a new piece of paper and lay it on its side. Is that correct? Okay. So let's go ahead and do that. Okay, who is our buyer? What?
Is it Santa Fe?
Our buyer is Santa Fe. Okay. So our buyer is Santa Fe. And who is our seller? Mesa. Very good. Okay. So let's take a look at this. Let's start with the buyer here. This is not a T account. It looks like one, but it's not. Okay. All right. Well, they purchased the merchandise inventory, and we credit accounts payable. We're in the perspective of the buyer right now. For how much?
$24,000.
$24,000. Okay. You with me? Now, let's shift over to the seller. How does that look on the seller side? Well, they have an accounts receivable for $24,000, And that was what their sales were for. So they booked the sales, they credit sales for 24,000. Correct? But the seller has an additional journal entry to make, don't they? They have to debit cost of goods sold and credit merchandise inventory for 16,000, is that correct? Okay. They don't have a second entry on the buyer side, right? Okay. So sometimes it's kind of nice to look at those side by side to see what the differences are. Now, does the buyer pay the seller within the discount period?
Yes.
Yes, they do. So how much cash do they have to pay? They don't have to pay the full 24,000, do they? They have to pay 97% of that, right? Which is, if I do that in my head, 23280? Is that right? No, I looked at the answer. Okay, but the entire accounts payable goes away, doesn't it? So where does that little 720 get credited to? Merchandise inventory, correct? It brings the inventory down to the amount that the buyer truly ended up paying for it. So they send a check of cash for $23,280 to the seller. They open up their mail. There's the cash, $23,280. Now they have to decrease by crediting accounts receivable for $24,000. Okay, because the seller's not going to receive anything more from Santa Fe. Where does that little 720 go? Here. Sales discounts. Very good. So, that's how she looks, isn't it? Okay? Questions on that? Another good one to practice before the test. Okay? All right. Questions? I know we still have more. All right. Let's do exercise 514. Exercise 514. Okay?
Letter C in the same exercise that we didn't cover.
Say that again.
On exercise 5.6, we didn't do
Oh.
option C.
You're right. Thank you. They changed that from the previous edition, didn't they? So, good job. Thank you. Okay? All right, let's take a look at that again. I don't remember where I put my stuff. Here it is. Okay. Thank you, Tiva. Okay, this was pay within the discount period, correct? Right? Well, what if they did not pay within the discount period? Okay? What if they paid too late? Okay? Well, let's take a look at how that would look. It'd be pretty easy, wouldn't it? Okay? They would just have to they'd pay the full amount, wouldn't it? And they would receive the full amount. So it looks different than that, right? Here they only had to pay and they only received 97% of this, but if it is paid outside of the discount period, that's how it looks. Cool? All right, questions on that? Thank you, Tiva. Okay, let's hop over to exercise 514. Now, the exercise 514, this was in something I wanted to have you read about. Do you remember the current ratio? Very good, Maria. The current ratio is current assets divided by current liabilities. Current assets divided by current liabilities. And it measures a company's ability to pay their debts in the short term, correct? Now, I want you to read about the acid test ratio. And I'm going to show that to you in a second here, but let's use a little example, okay? Okay, let's say that you had, Kyle, let's say you had $10,000 worth of current liabilities. And let's say that, Jacob, you also had $10,000 worth of current liabilities. Okay? You with me? So you both have current liabilities at your individual companies of $10,000. Let's say that you have current assets of $20,000. And you also at your company have current assets of $20,000, right? So what is Kyle's current ratio? 2. What is Jacob's? 2. Same. So using the current ratio, which we learned earlier, both of them have an equal ability to pay their debts in the short term, correct? However, let's say that Kyle's $20,000 of current assets were comprised $19,000 of cash and $1,000 of prepaid rent. Okay? Let's say your current assets were $1,000 of cash and $19,000 of prepaid rent. Now, which of these guys has the better ability to pay their debts in the short term? Kyle. Because his current assets are more liquid. They're closer to cash. You with me? But the weakness of the current ratio, although it's very popular, is that it treats all current assets equally. Whether it's $10,000 of office supplies or $10,000 of cash, which is kind of crazy when you think about it, right? Can't pay your bills with office supplies, right? So we take a look instead at the acid test ratio. And the acid test ratio measures the same thing. It measures a company's ability to pay its debts in the short term. However, it says time out. We're not going to use in our numerator all current assets. We are going to be more specific. We are only going to use, and we call these the quick assets. These are cash, short-term investments, and receivables. The denominator is the same, current liabilities. But the numerator is only cash, short-term investments, and receivables. Are you ready? Because this recognizes the quality of the current assets. And a rule of thumb is you want this to be at least 1. So, exercise 514, is that right? It gives us this information right here at the top of the page. Okay? And it wants us to compute the current ratio and the acid test ratio for each of these cases. You can kind of think of these as companies, okay? So let's take a look at that, okay? Let's take a look at that. Let's compute the current ratio and the acid test ratio for each one of those cases or companies. Okay, first of all, let's do the current ratio for each one. Check to see if you got those correct. Did you get a current ratio of 2.6, 3.5, and 1.95 for each of those? Okay. Which one of those, using the current ratio, has the superior ability to pay its debts in the short term? Case Y. Okay? Case Y, right? Now let's compute the acid test ratio. Well, the first thing we have to do is we have to compute the quick assets. And again, those are cash, short-term investments, and current receivables. Now, I know the previous slide just said receivables. A lot of times I'll use current receivables because if they have a receivable that's like 3 years old, they don't use that. Okay? So their quick assets for company or case X, Y, and Z are these numbers here respectively, which we then divide by the current liabilities amount, same amounts that were up there, and we get acid test ratios of this. Did you get those? Now, which company has, using the acid test ratio, which company has the superior ability to pay its debts in the short term? X. Up here it was Y, right? So it gave us different conclusions. And the reason is when you look at the composition of the current assets, looking back on this, case Y had the superior current ratio, but they had a lot of current assets were in inventory and prepaid expenses, right? Which are not very liquid. Case X, they had a lot more liquid assets, didn't they? Make sense? Now, which of these do you think is the superior ratio if you truly want to know a company's ability to pay its debts in the short term?
Acid test.
The acid test. Which do you think is more popular?
Current ratio.
Current. I would agree. Why do you think the current ratio is more popular?
It makes companies feel better about their situation than it
Well, it could be. Could be. It's what?
Easier to.
It's easier to compute. Because think about it. On a classified balance sheet, remember, current assets and current liabilities, they're always subtotals that are not listed, aren't they? So it's just so easy to compute. Whereas with the acid test, you got to go, okay, now is that a quick asset? Is that a quick asset? You see what I'm saying? So I actually, when I go to a client, I will compute both of them over time and see if they're trending upward, which makes me happy, or if they're trending downward, which makes me concerned. Cool? All right, questions on exercise 514? All right, we just keep moving along, right? Now, I think the next one is that I want to go through is Quick Study 514. Quick Study 514 is as shown, okay? Now, before we go to that, I want to hop over to the slides a little bit. And I want to go to a section that's called the multiple step and the single step income statements, okay? There are two different ways primarily to prepare income statements at your point of it, learning at least. Let's look at the single step first of all. The single step is pretty simple. And it just has your net sales, and then it lists out all your expenses. It groups them together. Total expenses of this. There's your net income, 12.9. That's the single step method, okay? Now, the multiple step method is more specific, okay? It's going to, let me get my pointer going. It's going to have your sales, which is your gross sales, and then it subtracts out those contra revenue accounts, right? And that gives us net sales of 317,500. You with me? Now, we like to, remember when we were debiting sales discounts and sales returns and allowances as opposed to sales? The reason we want to do that, show me with the screen here real quick. It's nice for us to know that our gross sales were this, but our net sales are that. It's nice for us to know those numbers as managers, isn't it? Because we want to know how much returns there are. We want to know how much allowances we're giving. We want to know how much discounts our customers are taking. If we didn't use those contra revenue accounts and instead just debited sales in those instances, we would only have that number, right? And I think it gives us more information to have that number, all these numbers. Then we subtract out cost of goods sold, and we get what's called gross profit or gross margin. This was on your quiz, right? Then we have our operating expenses, and a lot of times they'll divide those up between selling and administrative. We'll total those up, subtract those from gross profit to get our net income. This is the more common way you're going to see income statements in real life because it gives a lot more information than this one right here, right? That doesn't give the reader much information. This does. Now, hopping back over to exercise 5 or quick study 514, they give us some numbers and they want us to compute net sales, gross profit for each separate case, and then they want us to compute what is known as the gross margin ratio. Now, what is the gross margin ratio? Well, I'm glad you asked. The gross margin ratio is your gross profit divided by net sales. Now, your gross profit is computed as taking your net sales less your cost of goods sold. Okay? So, some companies have a high gross margin ratio. Some of them have a low gross margin ratio. Okay? Let's talk about a company that has, or not so much a company, let's talk about this a little bit. Here is a product that has a very low gross margin ratio. And when we say a low gross margin ratio, what we're meaning is that their sales price is not much above their cost of the good when they purchased it. Milk at a grocery store. How much does milk at a grocery store? A gallon of milk. What's a gallon of milk cost these days? What do you think? $3 maybe? So, you buy a gallon of milk, it's $3. Now, I don't know all the exacts, but I have heard that the cost for the grocery store, when they bought it from the dairy farmer, a lot of times it is not much below what they're selling it for. Like maybe they paid $2.75 for it and they're selling it for, they paid $2.75 and they're selling it for $3. There's not much markup there. So the gross profit divided by the sales is going to be low, isn't it? You with me? Now, do you know why grocery stores often have a low gross margin ratio on their milk? Nathan?
Because they encourage you to buy more, and so they make up for the lower margins with just large quantities of sales.
Well, you're half right. You're half right. You're on the right track. I'll clarify here in a second.
It expires quickly.
Yeah, let's combine both of your explanations. Here's the deal with milk. You can't buy it in mass quantities. That was where you were.
Customers,
Okay,
it's a high volume item.
I see what you're saying. Okay, here's the deal with milk. It's like you can go to Costco and buy 10 things of toothpaste, or 10 bags of chips, or a big thing of peanut butter or whatever, right? But if you went to Costco and they had a 10-gallon thing of milk, would you buy that? No.
If you're in an industrial kitchen, you might.
Because milk goes bad quickly, right? Milk goes bad quickly. You have to, you can't keep a lot of it on stock. It goes bad. So you have to shop a lot for milk. You have to go to the grocery store a lot for milk. A lot of times I will get a text from my wife, can you buy some milk on the way home, right? And I'll run in and get milk. Now, do grocery stores put milk right up front? They know that's all you need is milk. So they put it right up front so you can just run in and go. No. Where do they put it? They physically find the farthest place in the store, and that's where they put the milk, right? Because what they want you to think is, okay, I'm running in, I'm just going to get some milk, I'm going to be gone. Hey, there's a new kind of Doritos. Well, what the heck? Put that in there. And hey, oh, that reminds me, we're going to have hot dogs tonight, so I need to get some ketchup and mustard. Okay, cool. Oh, this reminds me, I need some Cocoa Puffs, so I get some Cocoa Puffs. And before you know it, you got a whole cart full of stuff, and you just came in for milk. Well, the grocery store, and this is what you were alluding to, Nathan, they're willing to say, you know what? We're willing to not make a lot of money on the milk because we'll make our money on the Cocoa Puffs, the Doritos, the ketchup, the mustard, that sort of stuff, right? And they know you when you walk by, you'll go, oh, that looks good, right? They want to be the grocery store you choose to buy your milk at. Okay? If they marked it up high, you might go, I'm not going to go to the Price Chopper, I'm going to go over here to this one. And then they would reap the benefits. Okay? Nathan.
I mean, it's notorious with grocery stores to have low margins on their products, but it's one of the only places they'll go and make weekly, $100 to $200 purchases.
Yeah. Grocery stores are kind of a whole different animal.
They just make all their money on volume sales.
Yeah, they do. It's more in volume. But they do have products that they have higher margins on than others.
Yeah.
Let me tell you a product that has a very high margin. there's a lot of markup above sales. Beer at a Chiefs game, okay? Now, I know a lot of you are under 21, so you don't know about beer. But for those of you who are above 21, or maybe your parents have talked about beer, do you know how much beer costs at a Chiefs game?
$6 or $7, I think.
It's like $10. $10 for a beer? Do you know what their cost was for that beer?
Like
A dollar.
Not even
Less
a
$80,
dollar.
yeah.
Maybe 25 cents.
Isn't it like
When you buy beer in bulk, it's cheap. So they're selling a beer for $10 that costs 25 cents. They can get away with it though. Why? There's no other competitors, right? And a lot of people really want beer. Okay? All right? You see so beer has a very high gross margin ratio. Milk, not so much. Okay? All right, I got to get moving or we're not going to get through our lecture. So let's take a look at the answers. There is Quick Study 514. Let's take a look at the answer to Quick Study 514. Now, I highlighted in yellow the information that they gave you, okay? The information that was provided. So, we see that sales, less sales discount, sales returns allowances gives us net sales. We subtract out the cost of goods sold, we get gross profit, or sometimes called gross margin. Our gross margin ratio, thus, is our gross profit divided by sales, net sales. 36.2, da-da-da-da-da. Who has the highest gross margin ratio? D. Okay? And another way of thinking about gross margin ratio is if your gross margin ratio is 36.2%, that implies for every dollar of net sales, you earn 36.2 cents in gross margin. Cool? All right, questions on that? Got to move along here. Okay, we have two more quick studies to go through. 5.9 and 5.10. Is that correct? 5.9 and 5.10. Okay, there they are. Nixit Company's ledger on July 31st, its fiscal year end includes the following selected accounts that have normal balances. Now, they did a physical count of their year-end inventory, and when they did a physical count, the physical count said they had 35,900 of inventory. However, their books say that they have 37,800. Well, which is right? Is the count right or the books right? The physical count is what's correct, right? Okay. So, why are those amounts different? Let me ask you this. Anybody here work at a retail store? Okay. Tiba, where do you work?
I work at Staples.
Staples, great example. Do you ever do an inventory count at Staples? Is the physical count ever different from what the books say?
All the time.
Okay. And why is that?
Maybe theft.
Theft?
The
Could be one of the
fluctuation of the
reasons,
prices.
or-
Well, no, we're talking quantity. It's a good question, and it's a Chapter 6 question.
Or damaged item that might be forgotten to be coded out from the system.
Right. So there could be theft, there could be breakage, there could be other reasons too, right? Maybe you just lost it or something. Is there a certain type of product at Staples that has a tendency to be stolen more than others?
Yes.
And that would be?
Well, let's say it depends. We get a lot of steals on toners and ink.
Okay, I've heard this. Toner and ink. First of all, just an editorial comment. They rip us off on toner. They like sell you the printer for $100, and then the toner's like $45. It's like it's almost cheaper just to buy a new printer, right? And I think a lot of people feel that way about toner, and so they probably use that to rationalize stealing the toner, right? They're ripping me off. I'm just going to put this in the back of my shirt and go on out, okay? It's easier to steal, though, isn't it? It's about this big.
Not even the large.
Even the larger ones.
Then like
Okay.
they take it and run away, like
They
right
take
in
it
front
and
of.
Right.
It's a very recent situation.
Just like Kareem Hunt, just running down the field with toner, okay? Well, it's harder to steal like a desk, isn't it? Okay? It's easier to steal toner. Anybody else here work retail? Colton?
I mean, yeah, I work Hy-Vee.
Okay. Are there certain things that get stolen more at Hy-Vee?
Stuff from the pharmacy a lot, like HBC, health and beauty care, like
Really?
yeah, like because it's where more of the we keep like there's a lot of expensive items over there, so
Okay.
people try to go over there and
Okay.
see what they can get. Or we get a lot of underage like alcohol thefts, like they try
Yeah.
to go into wine and spirits and then walk out the front door.
Okay. Yeah, those crazy kids. Go to a Home Depot or something, or a Lowe's, and what do you think in Lowe's has more chance of being stolen than anything? It's the power tools. People want to steal power tools because they're smaller, they're kind of impulse items, they're worth a lot. So if you notice at Home Depot, they have those segregated usually in their own area, and there's a lot of cameras above it. There's not a lot of cameras above the bags of cement because that's harder to steal. And usually the sort of people who steal don't make things with cement. They're just watching Netflix or something, right? But people want power tools, right? So there's certain items that have a tendency to have more theft. But when you have a difference between what your merchandise inventory in your book says compared to your count, you have to write it down. You have to make a journal entry. And the journal entry that we make for this $1,900 difference is we decrease merchandise inventory by $1,900 and we debit cost of goods sold. Now, sometimes companies won't debit cost of goods sold because people say, well, we didn't sell those goods. But some companies debit cost of goods sold because they just consider that part of the cost of doing business. Okay? But this is the adjusting entry they make. Are you with me? All right. 510 continues on with those numbers, and they want us to post the first two closing entries, don't they? And those are right here. And what they're just pointing out is those accounts in yellow, those are new accounts that we have learned in this chapter, right? And as an aside, those would be great ones to add to your flashcards, right? So that you know what financial statement they go on, what their normal balance is, if they're temporary or permanent. These are obviously temporary because we're closing them. Sales discounts, sales returns, and allowances are closed with the expenses. I think the rationale is they're closing all temporary accounts that have a normal debit balance with that entry. Are you with me? Okay. All right, I think that's it for the homework, is it not? I'm sure it'd be nice if I let you go a little early. However, I have about 3 or 4 minutes of lecture I want to do real quick. We're going to dip our toe in chapter 6, okay? So I want to take a look at chapter 6. This is a continuation of this topic. So chapter 6, inventories and cost of sales, okay? Okay, we know that merchandise inventory includes all the goods that a company owns and holds for sale, regardless of where the goods are located when inventory is counted. We have to consider some different areas, though, here and how we account for them, some different topics. Let's talk about those real quick. First of all, goods in transit. Okay, think about Walmart. Let's say Walmart has a December 31 year end, and they have to do a physical count of their inventory on December 31st. Well, think about how many trucks that they have at that given point, either taking stuff away from them to customers or bringing stuff to them for manufacturers. Tons of stuff, right? Well, who counts it on their inventory while it's being transported? And I think I told you earlier that whoever's paying for the transportation is the one who includes it in their inventory while it's being transported. So if it's FOB shipping point, then the buyer is paying for it and it's on their books while it's being transported. If instead it's FOB destination, the seller is paying for it and thus it's on their books while it's being transported. Make sense? Okay. Now let's talk about consignments, consignor and consignee. Have you ever heard about consignments? Here's an example. You can come off that. Let's say that there's a little Hallmark retail store, and an elderly a lady comes in and says, hey, I make these homemade earrings. Could you put this little display in your store and sell earrings that I made? And for every pair that you sell, I'll give you $2. And the store might do that because they make $2 on each pair, and it's nice to be nice to the customers. And she might tell her friends, and they come into the store and buy other things, right? In that sort of example, the elderly lady is the consignor, and the Hallmark store is the consignee. Even though the goods are in the consignee's location, the Hallmark store, they don't include those goods in their inventory. The consignor, it's in the consignor's inventory on their books. Does this make sense? Okay. Sometimes this happens with an auction or with a home shopping network. A company will give the home shopping network a bunch of stuff to sell, and even though the home shopping network has possession of it for a brief period of time, the inventory is not theirs. It's not on their books. It's on whoever the consignor was. Make sense? Okay? Not too tough. What about goods that are damaged or obsolete? Tiba, you mentioned this. What happens if you go to a product and it's broken? I mean, if it's completely trashed, you need to remove it. Well, what if it's just got a scuff or a scratch? Or what if it's obsolete? We'll talk about those issues, okay? You work at a grocery store? Yeah. And you have to do this, right? Because you'll see fruit that's gone bad or milk that's gone bad.
Yeah, like that stuff's out of date. Damage is like crushed, like if a pallet crushes the boxes or something like that, and
Right.
theft. Like we have 3 different categories. It's like damage, out of date, and theft.
Okay, good. Good. So we'll talk about how we handle that in this chapter. Inventory costs. We've kind of talked about this before a little bit, but in inventory costs, we are going to include all expenditures necessary to bring an item to a sellable condition and location. So not just the invoice cost, but delivery. If there's insurance we have to pay. All those sort of things. Let me give you a quick example. I know we're running out of time. But let's say we're a piano retail store, okay? And let's say that we pay $1,000 from our manufacturer for a piano, okay? And then we pay $100 to have it delivered. And once it's delivered, well, and let's say that while it's being delivered, we paid $50 for insurance on it while it was being delivered. And then once it's delivered, we pay a guy $50 to unload the piano and tune it so it's all ready and looks nice in our showroom, and hopefully we sell it to a customer. Well, that piano would be recorded on our books, not at the $1,000, but at the $1,200. Because those are all necessary expenditures to obtain that item and get it ready for sale. Cool? Real quick, this is the last slide, I promise you. Last thing we have to say is, no matter where you work or what sort of inventory system you do, you have to do a physical count at least once a year. How often do you guys do yours at Staples?
Absolutely, like more than 3 times a week, maybe
Okay.
sometimes
You do it
daily.
Number of times?
Yeah, we keep up with it. Like we kind of break it up, but
Okay.
just different departments do it at different times.
Okay. All right, just give me 30 more seconds. Don't put your stuff away yet. I know you're eager. Okay. They love to have college kids do inventory counts. And because a lot of times they'll do them in the middle of the night, and you guys can stay up late at night better than some of us, right? So how many people have done an inventory count at one point? Okay. Tiba, have you participated? No? Okay. A lot of times there'll be ads for college students to do inventory counts. So these are the sort of issues we're going to talk about, okay? Do the homework that's on your sheet. Make sure you bring your calculator to the next class period. And we are going to be using those inventory worksheets that I gave you, okay? Folks at home, those are with all your other handouts. So do your homework. We'll see you next time. Bye-bye.